Let's get to Dave Pearce anyway. I've mentioned him already. He is the Director of Strategic Initiatives and joins us now. Dave, really nice to see you. Happy second half of the year. It looks...
Yeah, it's great to be here.
Well, it can only be better for some of the bulls, I presume, in the second half of the year. In fact, why don't we make that a question? Is it going to be better in the second half of the year?
Ooh, that's a hard one, isn't it? Throw me out of softball to begin with. I think we're still headed the wrong direction right now. And I can't see how we can stop the inflation that we've got going on. We've got interest rates that are going up dramatically, but we're still seeing lots of governments that are offering incentives to their people to try to help compensate for this. I don't see any way that we're going to really recover the price of oil and get that down. So some of the real basics in our lives are just, they're still kind of out of control. And until we can get our arms around that, I just don't see how it can be a lot better. Could we get to where we're kind of getting flatter? Yeah, probably. But as far as getting really better, I have a hard time seeing that right now.
Yeah, I hear you, David. I have a lot of sympathy from your point of view. I mean, look, some of the strategists will point out that there was a mighty old rally after that big decline back in 1970. The other thing I will say, which makes me slightly less curmudgeonly than I normally am, is the fact that realization that valuations are slightly more realistic. Now, I know that's only based on the premise that earnings will be as advertised at the moment. And if we do see a lot of earnings revisions and margin problems going forward, then of course the PE that we have now isn't actually accurate. So are valuations more accurate? Are they more enticing? Or again, just a little bit of caution there?
I think that they're a lot more enticing than they were a few months ago, obviously. But I'm still holding off right now. I'm not putting all my eggs back in the markets right now, because I think that we've still got a ways to go. I think there's going to be some additional retracements that we're going to have in the marketplace, and I think that is probably necessary. When you have interest rates doing what they are, it's really hard to keep things stable and just working and going one direction. We've got to have you've been in the markets as long as I have, and I'm sure, and there's always rebounds, there's always corrections, and then that's always followed up by times of plenty. And we've had a lot of plenty over the last few years, and it's time. It's not surprising to see a correction happening like this.
Dave, we've been talking a lot about dynamic investing, dynamic strategies for years now, but very relevant of the first half of the year, just how quickly investors had to change tact from, a pace of rate increases to rapid increases. And now the situation perhaps with stagflation or even a recession, it feels like there are more twists and turns ahead. And if I can just take you to the sectors then, because it feels that investors have been trying to position on markets by taking bets off, but also rotating by sectors. And if you look at the slump we saw in FANG plus stocks to the tune of 43+% versus about 20% stripped off the banks, what do you think rotation will look like in the second half of this year based on these twists and turns we still have ahead?
Well, we have seen a lot of the tech stocks come off, and you talked about the FANG stocks, and that's something those are the ones that we've seen the biggest gains in. The stocks that seem to be best, in my opinion, are stocks in commodities and, the things that people need to have every day, the necessities, the, healthcare, anything to do with, food and, clothing and things like that. Housing, I'm not quite sure on that one. That one's kind of up in the air, because with the way interest rates are going, that's a long-term big investment. So even though that is a kind of a stable thing, I think that we're going to see some, a little bit of withdrawal in the housing market. I think you have to with the way interest rates are going, because prices are just going way up. But I would stick with more staples.
And Dave, can I ask you about the data? I mean, we had the PCE yesterday, the inflation numbers, not as hot as the numbers could have been. But that said, it doesn't really seem as though the data is reinforcing some expectations out there that inflation has peaked yet.
I don't think it has. I think it is still going on, and even with the severe interest rate increases that we've seen, you've just got to think. You think about the main things that people are consuming. I mean, the price of gas and oil go into so many things that we consume, not just the fuel we put onto our cars. It's heating, it's the containers that we use, it's everything that we have in our lives. And until there is some type of a resolution with what's going on in Russia right now in the war in Ukraine, or there is time for the oil companies to be able to ramp up their production, which does not happen overnight. That's going to be a 6-month, at a minimum, process. And then you've got to really wonder how willing they are going to be to really jump in with both feet to ramp up production when we might have an end of the Ukraine war, and then the whole Russian supply is back in the marketplace, and then we've got an oversupply of oil, and the prices drop through the floor. So I think there's some caution in the oil industry, and they are, which is I think justified. But until we get that under control, I don't see that inflation can stop.
Yeah, I hear you. And the one thing about, you say I've been around quite a while. Unfortunately, I have. And the one thing about the oil market is it always surprised you. For instance, from 2011 to 2014, we were all waiting for the oil price to decline, and it stayed stubbornly above $100, if I remember correctly, as well. And then suddenly it dropped off a cliff as well. So when it changes aggressively. So I think you're spot on, Dave. I think the industry is very, very cautious about what the politicians are now telling it to do compared to what they were telling it to do last year and the year before that as well. So where does one put one's money to find not only a safe haven at the moment, but actually a decent bit of income?
Well, if you look at, I'm a currency expert, and so everything to me kind of goes back to the currency markets, and I look at where the professionals are putting their money at, and what's the strongest currency in the world right now? It's the dollar. The Japanese yen is really weak. The pound is weak. The euro is weak. And so the smart money seems to be heading to putting their funds in the U.S. because it's been traditionally a safe haven, and money is flowing here into the U.S. It's obviously not going into the stock market. It's going into bonds. It's going into safer investments. It's going into, and I still think that there's a lot of demand for real estate, not just residential, but commercial real estate. There seems to be huge demand for that as well. So I think that there's a lot of money moving into the States, moving into things that are tangible assets rather than just speculative assets. I think that, we look at the whole Bitcoin and cryptocurrency world. There's so many people that were just wanting to jump on the bandwagon and throwing everything that they had at that in hopes of becoming billionaires. And I think that there's a lot of people learned a lesson that something that can go up really fast can go down just as fast as well. So I think there's a lot more caution in the market now than there was even 2 months ago. And people are looking for a little bit more stable return on their investments. And, getting a 3, 4, 5% return right now sounds really, really good. Whereas, 6 months ago, if you weren't getting, double digits a month, it sounded horrible.